Hello and welcome to episode 31 of the Alex Nunemaker Mortgage Podcast for the week of February 6, 2023. In market news, we take one step forward and then we take a step backwards when it comes to mortgage rates. So after some positive news last week with the Fed acknowledging finally that inflation was easing, Friday we got the BLS jobs report, which was not expected to be a huge market mover, but it came in with a very, very surprising 517,000 jobs created, and the market was only expecting 185,000, which would indicate this blistering, growing economy, which would not be good for corralling inflation. This was very, very surprising because not only did it just completely blow expectations out of the water, but the ADP employment report had shown only 106,000 jobs created just the week before in the same time period. So the ADP report is kind of viewed as a little bit more accurate because they survey 25 million payrolls. So they really do get a lot more on the ground type data. So why the big difference? So if we look at the BLS jobs report, they've started some new methodology on how they report and they interpret data with some new ways that they adjust for seasons, population control, and there's not a lot of information on exactly what those adjustments are or how they arrive at it. So if you take a look at it, the raw numbers were very close to what they were expecting, but then the adjustments is what basically accounted for this huge jobs report. So is this a real number? I suspect not. But in the meantime, the market still has to react to this huge number. Plus, there's been news overseas from both the Bank of England, the European Central Bank, and some other central banks who are countering the tone from the U.S. Federal Reserve. So they're starting to temper maybe how much more they'll need to hike rates, but then these other central banks are saying that they're going to need to continue tightening monetary policy, hiking rates, because as they say, over-tightening and choking economic activity is the better alternative to loosening too quickly and letting inflation get out of control. Were they, maybe reacting to this job support? Who knows? But interesting times that we live in. I don't necessarily expect this to linger too long. It's really just kind of a blip. We're just adjusting back to kind of where we were prior to last week's inflation report. It's going to take some time for the market to digest this news, but we've done a good job of actually battling back a little bit so far this week. So just keep in mind, it's not a straight shot down in terms of mortgage rates. There's going to be these, up and down movements. In the mortgage corner, let's talk about trigger leads. If you've never heard of this term, some of your clients have definitely experienced this, and it's only gotten worse this year. So when your client applies for a loan, we pull their credit, and then in some cases, literally within seconds, they'll start to get bombarded with calls from other mortgage companies. Is this some evil plan where we sell the client's information to these mortgage companies? In short, no. I get that question a lot, but if you really think about it, it doesn't make any sense. We're a mortgage company. We make money by originating mortgage loans, not by selling information to other mortgage companies who could potentially then close that loan. What's actually happening is the credit bureaus are making money and they are selling that client's information, at least their contact information. Unless the client has opted out on these types of marketing calls, more on that later, credit bureaus can make money by packaging up these marketing lists of people who are inquiring about a mortgage. Hence the term trigger lead. So the trigger is that they apply for a mortgage, the credit bureau sees that and says, hey, this person just inquired about a mortgage. They sell it to this company, and they have basically teams on call that their job is to get in front of that client as quickly as possible to try to convince them to use them. So I'm not exaggerating when I say in some cases I'll have clients say that they get 20 or 30 phone calls in a single day. And that's incredibly confusing, frustrating, and one way to avoid that is to have them opt out of these pre-screened phone calls. So the credit bureaus have set up a website, optoutprescreen.com. This is not only going to stop those phone calls, but it also stops a lot of the other forms of marketing that they might get in the form of junk mail and other solicitations. So it's very easy. I did it myself. Takes only maybe 3 or 4 minutes to do it. It does take about 72 hours for the opt-out to actually go into effect. So if they're not really in a hurry to apply and they've got a few days, I would encourage you, when you are going through your initial consultation with a client, mention this to them. It's a great value add to help keep them from getting, harassed by these phone calls. Finally, our quote of the week: use your time and energy to accomplish great things instead of worrying, placing blame, or spreading criticism. That's by Les Brown. Have a great week. If I can help you or any of your clients with any questions or pre-approvals, let me know. They can visit me at homeloanswithalex.com. Have a great week.